This is a studio version of a presentation for the 2015 Symposium of the Institute of Advanced Financial Planners. I'm Pramod Sharma, your actuary at Taxevity, for questions about insurance. When you're working on a financial plan, what are you solving? A puzzle? You need all the pieces. It helps to know what the final picture looks like before you start. Or a mystery. More information isn't better. You face high uncertainty. You want the fewest relevant clues. Puzzles come to satisfying conclusions. Mysteries often don't. An actuary lives in the world of statistics and probabilities, the world of uncertainty, the world of mysteries. How products work and how advisors behave affects what insurance solutions clients get. After designing products and helping advisors sell them, I decided to help the public instead. I've provided free education through blogs, podcasts, YouTube, and live presentations. You're welcome to ask questions. Insurance helps replace the economic value of a machine, which is a priceless human being. Will the correct risks be identified and treated? Let's look at the CAT scan of a human lung. Radiologists are trained to spot risks. What did 83% miss? It's the size of a matchbook, 48 times the size of a cancer nodule. Do you see the gorilla? The invisible gorilla is an example of the inattentional blindness that affects experts. In case you're wondering, that is a real baby on the researcher's back. What we see differs from what we think we see. You get different perspectives and better results when you have a diverse team of independent experts. Insurance combines 4 distinct worlds, each requiring different expertise. Risk. What are the probabilities and severities? Accounting. Where do the premiums come from? Where do the benefits go? Investing. Insurance is not free. Could investing the premiums elsewhere give better returns? Law. You're buying a legal contract. How good are the guarantees? When you see the new aluminum Ford F-150, do you see better fuel efficiency and more performance? Or do you see more damage, more costly repairs, and more injuries? We see as we are. We see what we're trained to see. In my case, that's insurance from the perspective of an actuary. Let's look at how to do an insurance review. First, understand the 4 actuarial risks. They have significant financial impact. They are predictable for a population, but unpredictable for an individual. Next, look at each risk for each person. Disability risk is the financial harm from losing income when you're unable to work. You can get income replacement insurance, often called disability insurance. The benefits typically end at age 65. A client may get better results with the indexed lifelong benefits available with some long-term care insurance plans. Morbidity risk is the financial harm from losing health. The common solution is health insurance. There's conventional medical and dental. There are also private health services plans, which don't seem to be as well known. These are very good for routine expenses. You can add protection for catastrophic medical expenses and waiting time insurance to see specialists sooner. There is also travel emergency insurance. There's also critical illness insurance, which provides a lump sum to use as you wish if you're diagnosed with a covered condition like cancer, heart attack, or a stroke and survive 30 days. If you don't want to wait for treatment in Canada, there's queue jumping insurance. You can get quick prepaid treatment in leading U.S. hospitals for many more conditions than critical illness insurance covers. Longevity risk is the financial harm from outliving your savings. You can get an annuity which provides income for life as long as you and your spouse live, ideally indexed for inflation. You can save more than the RRSP rules allow with a personal pension plan. There's a component for the type of defined benefits we fund for government employees. There's a component for accumulating contributions as we do in an RRSP. There's a component for transferring amounts from RRSPs. You can also protect against the costs of long-term care with insurance. There are options to get a return of premium at death if there haven't been any claims. Mortality risk is the financial harm from dying early with obligations remaining. Life insurance tends to be the focus of insurance discussions, even though other risks are more likely. You have the option of protection which is temporary or permanent. We've looked at the actuarial risks and the typical insurance solutions. Let's now look at the three-step process which helps a specific client. First, forecast the financial loss. Compare what's needed with what's in place. This may already be included in your financial plan for each type of risk. Next, evaluate the current insurance. Pay careful attention to the source of the insurance. Public insurance comes from the government. This may seem to be free, but you have no control. Pooled insurance comes from your employer or an association. This may look free or cheap. Again, no control. Personal insurance comes to you from an advisor and an insurance company. This gives you full control, but can look expensive. Finally, there is the person themselves, you, self-insurance. This may look free, but if things go wrong, this can be the most costly. There's a risk of overestimating what's provided by the government. You pay with waiting time, and there are lots of rules. And also employers, if you're still working there, that is. Cost cutting affects the quality. For instance, you may think you have disability insurance, but the quality is likely much lower than what you would get with a private personal plan. What about the type of insurance? Does this match the need? For instance, some people will buy critical illness insurance for disability risk, or they may get permanent insurance for a temporary need, or temporary insurance for a permanent need. Are today's products materially better? In some cases, yes. In other cases, holding on to an older product is better. Also, examine the amount of insurance. Is there too much? Is there too little? Are the benefits adjusted for inflation? As Warren Buffett says, at bottom, any insurance policy is simply a promise, and as everyone knows, promises vary enormously in their quality. Who makes the promise? The salesperson. Who backs the promise? The insurer. Who pays for the promise? Your client, especially if the promise is of poor quality. The final step is to propose repairs. This means to fill gaps. This is often easy. Also, to repair weaknesses. This is more challenging. Products have pitfalls which may not be evident, for example, the F-150. We are now ready to look at the case study. This is your opportunity to participate. If you attended the symposium, what you might want to do is pause as we look at each person so that you can compare your own thoughts with what we discuss here. This case involves several people. The client pays and decides. Who is the client? This is where we would have a discussion to see what your perspectives are. For insurance, you are the client if you're taking responsibility for the process, or you can outsource the insurance work and remove yourself. Your clients are now responsible. What does or does not get done is up to them. Also, what is the scope of the assignment? What problem does the client want solved? We would have a discussion about this in the live setting. Here are the people in our case. We don't know much about Elaine, who is Nick's ex-wife, or Peter, who is Nick's dead dad. For our exercise, we'll ignore Elaine and look at everyone else. For each person, we'll examine each risk. If Peter were still alive, what insurance might he need? For morbidity, perhaps health and dental would be good for him. For disability, he's likely retired, which means he cannot get income replacement insurance. He could apply for long-term care insurance, though. Mortality, there's no spouse, but he does have a son and grandchildren. Estate planning could be done, for instance, to help the cottage be passed on more effectively. For longevity, an annuity would guarantee income, and long-term care insurance would help with expenses. What insurance might Kathy need? She lives on her own. Morbidity. She likely has generous health and dental coverage from work. What if she has a critical illness? She may need help with that. Disability. She likely has some coverage from work. She could fill gaps, and she might consider long-term care insurance because that's cheaper when you're younger. Mortality. This is less important since she is single. She could use universal life insurance for more tax-sheltered growth, or she might want to donate insurance proceeds. Longevity. She likely has a nice indexed pension. If she needs long-term care, who would look after her? Long-term care insurance might help with the costs. Is Nick incorporated or an employee? That affects some of the solutions we may propose. What causes his motivation to fluctuate, and thus his income to fluctuate? More income provides more money to solve problems. What insurance might Nick need? Morbidity. How good is the health and dental coverage from work? He could top up and get critical illness insurance. Disability. What kind of coverage is available from work? He could cover gaps and might want to consider long-term care insurance because it's cheaper since he's younger. Mortality. He's single and has independent adult children. Does he have much of a need? Longevity. What kind of a pension is available from work? If he needs long-term care, who would look after him? Long-term care insurance might help with the costs. What kind of benefits does a young hairstylist get? How secure is his job? What kind of insurance might Alex need? Morbidity. He could top up health and dental and consider critical illness insurance, possibly with a return of premium option. That would give him a form of retirement savings if he doesn't have any claims. Disability. A portable plan with index benefits would help. An option to increase coverage without underwriting would be good too. The definition also makes a difference. He could get coverage based on his inability to do his own occupation or any occupation. Mortality. Since he's single, does he have an immediate need? Longevity. Saving for retirement is important, and he might not need insurance. A TFSA or RRSP could be a good start. An idea is to consider a hybrid 3-in-1 plan that would provide protection for income replacement, critical illnesses, and life insurance. What kind of benefits does a junior car salesperson get? How secure is her job? What kind of insurance might Nikki need? Her situation is similar to Alex's. Morbidity. She could top up her health and dental and consider critical illness insurance, possibly with a return of premium. Disability. A portable plan with index benefits and the option to increase coverage without underwriting could be good. The definition of disability would also matter. Mortality. Since she is single, is there an immediate need? And longevity. She can save for retirement using something like a tax-free savings account or RRSP. Like Alex, she could also look at a 3-in-1 hybrid plan and then have protection for income replacement, critical illnesses, and death. We've looked at each risk for each person based on what we know. Now we turn to your questions on what we covered, or something else, your choice. Of course, we can't cover those questions because this is a video, but you can contact me. And you may find some answers turn into videos on the YouTube series Question and Actuary. You have a key role as a financial planner. That is insurance literacy. Educate yourself about insurance. Explore the risks and remedies. Get help with your questions. Educate your clients. They may not realize they need protection. Far too many people don't know what they want because they don't know what's available. Show them. You're a registered financial planner. Too few know what an RFP can do. Too few know you.